Hello and welcome to my channel. If you're new to the channel, don't forget to subscribe, and if you have already subscribed, welcome. I hope you've been getting values from all my videos. The last video I did on trading market structure, that was the part 1. This is the part 2 of that video, trading market structure. Last time we talked about trading the M's and the W's, and today we're going to talk about the different variants of the M's and W's, right? You already know that when it comes to trading, when it comes to profitable trading, you must have a good understanding of market structure. You must have a good understanding of technical analysis, because that's the whole, principle of trading this market. Because you can't begin to come into the market and hope to lucky your way through. You can't do that. For you to say you want to trade, you have to have proper mastery of market structure and all the technical analysis. So you analyzing the chart, you seeing these opportunities are the major step for you to making money, for you to profit it, right? So in this video, I'll be walking you through the different variants of the M's and the W's. So last time I said these M's and W's are sometimes called double tops, double bottoms, triple top, triple bottoms, and all of that. So they're sometimes called reversal patterns and blah, blah, blah. But here's the thing. Regardless of what you call it, it is still shaped like an M, shaped like a W. And when you see these patterns, trade them. When you see the M's, they usually signify a sell opportunity. When you see the W's, they signify a buy opportunity. Now you can use this structure to trade anything. Be the currency market, be the volatility indexes, be it even the crypto market, especially those ones that are listed on all the major crypto platforms, right? So you can use this strategy to trade any of those instruments, be it currency, crypto, volatility indexes, and all the other binary pairs, alright? So all you have to do is spot it first. In the last video, I said the first thing you want to do is spot the trend. You want to see that this trend is moving in this direction. So you've seen that this is selling market, and all you're just spotting is just M's within that selling market. And you can see here, this selling market started here and it dropped, and the market gave us this pullback, because usually whenever there is a drop, there's always that pullback which creates the levels. I'll talk about that in subsequent videos. So when that drop happens, create a pullback, and then it drops, and then can you see here, it created another M, and then it drop, created another M, and then it drop. So all you just have to do is begin to look for these M's and W's. And yes, you can find them on any time frame. You can find them on the 15 minutes time frame, the daily, the monthly, even the 1 minute. You can find them on any time frame. These structures are abundant on the chart, right? They are set to help you know the direction of the market, if this is a sell market or if this is a buy market. So at every time you're staring at the chart, you always want to make sure that you are seeing these structures and you're trading them accordingly. So what have I just said? When you see the M structures, you're technically basically looking for sell opportunities. When you see the W structure, you're basically looking for the buy opportunities. This structure has been since the beginning of time, right? It has been since it is the writing principle of a lot of strategies that most people are running around now. It is the writing principle of what is called the smart money strategy, or any other way you want to call it. It's the writing principle behind, think of any strategy you want to think of, even the best selling ones. These M's and W's are the writing principles of all of them. All you just need to do is see them. That's why I always tell people that it's not about the strategies, it's about the person that is using it. Because as far as Forex trading goes, market structure is the key. So if you build a strategy around market structure and give it a name, that is just you trying to make a name for yourself. It is still you taking this principle of market structure, principle of double top, double bottom, M's, W's, V top, V bottom, harmonic patterns and all that. You taking the T tops. You're taking all of these things from market structure and tweaking it and naming it after yourself and believing that you have just discovered the holy grail, but it is still fundamentally market structure. So market structure is what I teach in all of my masterclasses I have a 17-part video where I exhaustively taught market structure from start to finish, where I talk about all of these structures I've just mentioned, the teacups, the V-top bottom, the M's and W's in detail. So you want to make sure that you look for this video. It's right there in the description section. Look for it, click it, purchase it, and begin to watch. It's a stop and play, right? It's recorded, where you have to stop, play, watch, stop, play, watch, until you understand it, because it is a complete guide to profitable trading. All right. So market structure is the main thing. Forget about everything you're running around doing. Forget about all the indicators they sold to you. Forget about all the algorithms you bought. Market structure is fundamental. If you don't have a firm grasp of market structure, you will struggle with all the strategies that are out there. And I tell you, there are gazillions of them. So ground yourself in market structure. That's one of the things most of the things anyway, I teach in my channel. On all the videos I've done, if this is the first time of you seeing my video, you want to go check all my other videos. They are all based on market structure. All right. So you've just learned that when you see these M formation, you want to look for sell opportunity, because every time that the market continues to trend towards the downside, they present themselves. And check out the W formation. That's the reverse of it. Every time they present themselves, what you see is you see a buy market. So say you have been riding a sell market for a while, and you've been cashing out, making money from it, and then suddenly you see a W. What it's just telling you now is that this market is about to do a pullback, because whenever the W presents itself, it means the market is looking to ride up. All right, it's looking to ride up. Most of the time, it rides up to the beginning of the move. So the market started here as a W, dropped, created the neck, dropped, and completed that W structure. Right? So you seeing this kind of structure, it is not for you to now say, maybe you see this, you see this, you see this, and then you say you want to go sell it, right? No, seeing this W structure just lets you know that this market is about to be looking to pull back. And then after the pullback, what did you see? An M formation arise here, and the sell happened, and it kept creating those M's. So for every time it keeps creating those M's, it means the downtrend will continue, right? So what's the way now that you can now begin to trade it? I talked about it in my previous video about seeing it from the second leg, or trying to catch it from the neck. That is, see a breakout, see a retest, and then you take your trade. So what are the different variants of the M's and W's? The first one is that's the very common one. It's called the double top. That's the one where market picks up, or price picks up, does a clean drop, and continues to pick up, right? So let me put this. So you see the market picks up to that point, and then it drops, and then it picks back up, back to that same point where it started dropping from, and then it drops again. So this is the regular, what they call the double top. This is the regular M formation. The reverse of it is the W. You see the market drops to this point, and then picks up to create the next zone, then it drops to set back to that same point, and picks up to create that. So all of these, this is what we call the double top, or just simply the W formation. So seeing this like this just tells you that this is a sell structure and this is a buy structure. So on any time frame you can see these things. On the daily, the monthly, the weekly, the 4 hours, the 15 minutes, whatever time frame you can see. But the trick is always making sure that you find them on higher time frames. Because higher time frames gives you a better, direction, that this is the actual trend, this is the actual direction of the market. So seeing it on higher time frames will now help you say, okay, I'm actually trading in line with the market trend. Because every time you want to make sure you're trading in line with the market trend, you don't want to trade against the market. It's dangerous. I see a lot of people do it, they just want to get lucky, especially when price has done considerable drop. They try to catch that pullback. Well, it's all about strategy. Some people have mastered it to the point where they're able to do it. They're able to follow those ride up, and they're able to catch it and make money. They just take 10 pips or 20 pips. They pretty much is scalping. So they go in, they come out. They go in, they come out. Right? I don't subscribe to that style of trading because it is very risky. It's got a lot of risk involved in it. I'd rather a style of trading that lets you sleep at night, that lets you take your trade and go about your regular business. Like I always tell people who come into my trading academy that this market is not something that that initial time that you're learning it, you can invest time to study, to understand and all that. But the minute you have a firm grasp of it, it's a passive income thing. Something that once you take your trade, you don't need to sleep on the chart. You don't need to monitor the trade all the time. You just take the market and go about your day. Or sometimes you take the trade and in less than an hour, 45 minutes or even 2 hours, 3 hours, you're done with your trade for the day. You've made $100, $200, and you're already out. You're done. All right. So it's a very, very profitable side income business. So it stops you from it doesn't stop you from doing anything. It doesn't take your job from you. It doesn't take away your family time. It doesn't do anything. It just lets you earn passively. So what you're doing, you're trading as a retail trader. So as you're coming in to trade as a retail trader, you're coming in to make a profit, side income. So imagine making $100 every day from the side income. I think that makes a lot of sense to be able to sort out a lot of bills, right? So that initial time when you're learning it, you need to commit time. But the minute you get a firm grasp of it, you don't need to sleep on the charts. People ask me all the time, do I need to, stay all day? You don't need to, unless you want to make it a major income for yourself. Then you can say, okay, you know what? This is my job. This is my business. So I'm going to make sure I resume here in the morning and close in the evening and do that. Unless you want to do that, then you're taking more trade. You're trading heavily that way, which is also very fine, right? So regardless, it could be a passive income, it could be a major source of income, because I know a lot of people personally, it is a major source of income for me because I trade most of the time, right? So you decide how trader you want to be, how you want to be, and how you want to make your money. The money is just here. It's here for you to make. All you have to know what you're doing. So you've seen these two variants, these two guys right here. Don't joke with them. They are very, very, in fact, I like to call them prophets. They are prophets of the market. They tell you when the market is moving, in what direction it's going to move and all that. So the next variant of the M is what we call the extended M, right? Where you see price drop to this point and then it goes further away from the point where initially it dropped from, and then before it continues to drop. So this is seen as the extended M. Some people like to call it the outside bar, right? Where you see that the market, instead of it continuing here, it broke this zone and went all the way to that top. So it's in structures like this that gives rise to the head and shoulder that you're all familiar with. So when you see this structure like this, most of the time, when it begins to drop, it does that pullback. It does a pullback to this point. Say it drops from here, it does a pullback from this point, it goes all the way back. Let me take this up. So it drops here. Hold up. Alright. So it drops here and then gets to the next version or the next region, then it pulls all the way back. Pulls all the way back to this point and then returns. So it is extended M's like that gives rise to the head and shoulder. And of course the inverse of it would be the W1. So you see the market drop to this point, pushes back, and then it extends all the way down, alright? And then it pulls back up. So this is the one that gives rise also to the inverse head and shoulder. Because the market, after that pull up, it does a pull back to that point to create the right shoulder, left shoulder, and so on. Pushes back up. So when you see those extended M's and W's, most times they create the head and shoulder formation. Most of the time. So that's another variant of the M's that you will see in the market. And here's a typical example of that variant. Can you see how the market dipped at this point, dropped, pushed all the way back up, right? And then what did we do? Then it continued to drop. But after that drop, what did we do? We created that wing. So can you see? Like you already know with head and shoulder, the shoulders are not always going to be in the same direction. So they're not always going to be horizontal. Sometimes they're diagonal, right? So it doesn't matter how they move. You always want to make sure that you see them. So it could be horizontal like this, or it could be diagonal. So in this region, or in this case, this one was a diagonal one. So after that push up, creating the extended M, drop, and then does a clean pullback and follow. Another way you can begin to decipher how far it will pull back is by using the Fibonacci to measure the impulse drop. I've done a Fibonacci class in one of my videos. Go check it out if you've not done so. Right, so we don't extend this one. So that's one variant of the M, the extended one. The other variant of the M is you seeing that the market pushed up and then it dropped to this point and it didn't go that far out. It just stopped halfway here. And then what happens? Continue to drop. So this is seen as the inside bar where you see price just respecting that zone at that point like that. So all of these are different rates. The thing is to make you see if you trade it. The rules still apply. You either trade from the second leg or you trade it from the neck region. And like I told you, that's one of the things I taught in the 17-part video, helping you spot entries, knowing how to trade it from the leg. Because personally, I trade from the second leg because what you want to know why I do so. That way I get to cash out on all of this profit. Because if you're waiting for this, you have to wait for the break, you have to wait for the pullback before you now take it. Meanwhile, I have cashed out on all of this. So if the market is going to create either of the M's and W's, you will know, you will see from the second leg, you see a market that is tending to push forward, you see a market that is tending to continue, or you just have to see the trigger. And of course, your stop loss is no higher than 25 or 30. That's your stop loss. Because if for a structure like this, if you hit your stop loss, you know that the market has plans of continuing, so you don't rush in, you don't try to revenge trade. You already know that this market that hit my stop loss means wants to push further. So all I have to do is wait for the structure to be ripe for me to now take the trade. So that one is not a problem. So this is not the strategy where you now begin to set 100 pips stop loss or set one or leave the stop loss open. This is not the strategy where you want to leave the stop loss open. This is a strategy where you trade with the appropriate risk and money management. Because if it hits your stop loss, this one, you know that you need to wait for the market to be very ready, then you take the trade. So it's a win-win, right? Because even if it hits your stop loss, you're not ignorant by saying, oh my God, I hit my stop loss, alright, I'm not trading again. No. You already know that after the stop loss is hit, or you have to wait for another opportunity to present itself, and then you take, so you invariably make your money back, alright? So that's it right there. So this is the second variant of it. We've seen three variants, the double top variant, that's the regular M pattern. We've seen the extended M variant, and we've seen the inside bar variant, right? All of these variants follows for the W formation also. Alright, so the next one we're going to talk about, and I also said that the extended M gives rise to what? Gives rise to the head and shoulder. Alright, so after that extension, most of the time after that initial drop, it often drops with an impulse, like drops very fast. Because I mean, it has extended all of those extensions. Sometimes if they call it the stop hunt, it's going to look for all of the stop losses of, dumb money traders. They keep gunning for their stop losses, hit all their stop losses, and then begins to drop. They see all of those things play out. So if you're one of those that it hits your stop loss, don't feel bad at all. But you have to just wait for the next opportunity to get your money back. Right? You're not revenge trading. You're only getting in at the proper time. Okay? So when it drops to that point, it drops with a massive drop, then picks back up for a pullback, and then drops, giving you the head and shoulder. Alright? And the final variant that we're going to talk about, like I said, I discussed this strategy extensively in that video. So guys, I can't say it well enough. You want to make sure you get that video. It is a 17-part video, so that means there are 17 lessons. So you can imagine sitting through 17 lessons of pure market structure trading. That is all the learning, that's all the education you need to begin your profitable trading journey. So the last variant that we're going to talk about is, let me take this off. The last variant we're going to talk about is a variant that follows a market picking up, and then after doing that drop, right? So instead of it to do that continued rise, it begins to consolidate. So let me pick the highlighter to explain this. It begins to consolidate it. It begins to create levels of consolidation. It begins to create levels of consolidation like that. It begins to consolidate around this point. And after the consolidation, it now continues its upward move. So when you see structures like this is also another variant of the N formation. It's also another variant of the N formation. So structures like this, what traders often do is they will mark this zone, right? They'll mark this zone of consolidation. They just mark it out like this and wait for the market to break out of it. So the minute the market breaks out of it, they know that they can now begin to get ready to sell. So some guys will jump in, always buy and begin to buy because they've been taught that if you're going to trade breakout, you break the upside, you want to rush in to buy. They rush in for the buy, and sometimes it just gives them a little buy and then it drops immediately and hits the top of it. So that is not time for you to buy. This is a sell market. So there are days when it breaks back all the way and it goes all the way to this same point where it started from. While there are days where it goes halfway, like it just stops here. Sorry. Days when it just stops here. Alright? It doesn't get all the way to the top, it just stops here. So it is still the same, it's still following the same principle, of seeing the ends in different formations. So like I said, all of these things hinges on market structure. Whatever strategy they name it, whatever branding they give it, it's still market structure. It's telling that these things are on the chart. They're there for you to see. All you have to do is know where to look and you need to see them. Alright? All of these things, you learn them in the something part video. So you don't want to miss it. I hope you've learned something today. I'm very sure you have, because this is one strategy that most people don't teach, and they charge a lot of money and they don't teach it because they don't know it. So here you've learned it for free. Don't forget to share with your friends, and if you're new to the channel, don't forget to subscribe. Thanks for watching. I'll see you again in the next video where we're going to be talking about entry strategies based on the M's and W's. Have a good one.